Yo, listen up. Before we get into this, I gotta hit you with something real quick. If you click away in the next 60 seconds, you're choosing to stay broke in a system that was designed from the ground up to subsidize billionaire lifestyles. That ain't me trying to scare you. That's just the God's honest truth sitting right there in 70,000 pages of tax code that nobody bothered to read. But I read them, and what I found, man, it changed everything. See, most folks out here grinding 9 to 5 thinking Uncle Sam takes the same bite out of everybody's apple. Nah, 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 nah. The real ballers, the Bezoses, the Musks, the Buffetts, they ain't playing the same game as you. They ain't even on the same field. They got a whole different rule book. And today, I'm about to hand you that rule book, page by page. So buckle up, Buttercup, because what you're about to learn ain't taught in no schoolhouse. It ain't on the evening news. And it sure as shooting ain't something your tax preparer at H&R Block is gonna whisper in your ear. This right here, this is the playbook of the ultra wealthy. And it goes by 3 little words: buy, borrow, die. Let's ride. First things first, let's talk about the tax code itself. The Internal Revenue Code of the United States of America. 70,000 pages. 70,000 pages. To put that in perspective for you, the King James Bible, about 1,200 pages. War and Peace, maybe 1,300. The entire Harry Potter series, 4,200. You could stack all of them together, and you still wouldn't be a quarter of the way through America's tax code. Now here's the kicker, and this is what gets my goat every single time. Most regular folks think the tax code is a bill, like it's just this big old invoice the government sends you every April. Hey, you owe us this much, pay up or we'll throw you in the clink. And yeah, for W-2 wage earners, that's pretty much how it works. Your employer takes it right out your paycheck before you even see it. You never even get to touch that money. But for the wealthy, oh honey, the tax code ain't a bill. It's a set of instructions. It's a treasure map. It's 70,000 pages of loopholes, deductions, credits, deferrals, exemptions, and exclusions that were put there on purpose by lobbyists paid by the very people who benefit from them. See, there's 2 Americas when it comes to taxes. There's the America where you earn a wage and the government takes 30-40% right off the top before you can say Jack Robinson. And then there's the America where you own assets, stocks, real estate, businesses, and you can legally, lawfully, 100% above board pay dang near nothing. Zip, zero, zilch, nada. And the dividing line between those 2 Americas? It comes down to one concept, one idea that separates the sheep from the wolves. And that concept is called a taxable event. All right. So what in tarnation is a taxable event? It's simple, really. A taxable event is any financial transaction that triggers a tax obligation. When you get paid a salary, taxable event. When you sell a stock for a profit, taxable event. When you cash out your 401k, taxable event. See the pattern? Every time money changes hands, every time you realize a gain, Uncle Sam's got his hand out. But here's the $1 million question, actually. Make that the $1 billion question. What happens if the money never changes hands? What happens if you never sell? What happens if the gain just sits there on paper, growing bigger and bigger and bigger, and you never ever realize it? Well, let me paint you a picture. Say you're Jeff Bezos back in 1997. Amazon just went public. You're sitting on $1 million worth of stock. Now, fast forward to today. That million, it's worth 100 million, maybe more. Your net worth just went up $99 million. But did you sell anything? No, sir. Did you cash out? No, ma'am. Did any money hit your bank account? Not a red cent. So as far as the IRS is concerned, and this is the part that makes regular folks want to flip a table, you ain't made a dime. That $99 million in growth, it's what they call unrealized gains. And unrealized gains are not, I repeat, not a taxable event. Let me say that again real slow so it sinks in. You could be sitting on $1 billion in stock, a billion with a B. And if you never sell a single share, your federal income tax bill could be exactly $0. Meanwhile, the school teacher down the street making 60 grand a year is paying 22%. The plumber, the electrician, the nurse working double shifts, all paying their fair share. But the billionaire with the yacht and the private island, legally paying less than all of them, combined. Now, you might be thinking, okay, hotshot, but what good is all that money if you can't spend it? You gotta sell eventually, right? And when you sell, you pay taxes. So the system works. Oh, you sweet summer child. That's exactly what they want you to think. Because the ultra wealthy figured out a long time ago that you don't have to sell to spend. And that brings us to phase 1 of the strategy. Phase 1, buy. Now, this ain't your regular trip to the Piggly Wiggly. When we say buy, we're talking about acquiring assets that appreciate in value over time: stocks, real estate, private equity, businesses, art, you name it. The key here is that you're not buying stuff that depreciates, not cars, not clothes, not the latest iPhone. You're buying stuff that goes up. And here's the beautiful part. As long as those assets just sit there appreciating, you don't owe Uncle Sam a single solitary cent. Let's use a real example. Say you take $1 million and you buy shares of a company. Good company, solid fundamentals. Over the next 20 years, that stock grows at an average of 12% a year. Do the math. And I know math gives some of y'all the heebie-jeebies, but stay with me. That $1 million turns into about $9.6 million. Almost 10 million bucks. Your gain, $8.6 million. And your tax bill on that gain, zero. Goose egg, nothing. Because you didn't sell. You just held on. You bought and you held. Buy and hold. Warren Buffett's been preaching this since before most of y'all were born. Now, Buffett himself, God bless him, he's admitted publicly that his effective tax rate is lower than his secretary's. He said it on national television, and people just kind of shrugged and went back to watching Dancing with the Stars. But he wasn't bragging. He was trying to tell y'all something. The system is rigged. Not illegally rigged, legally rigged. There's a difference, and that difference is real important. So phase one is simple. Accumulate assets. Let them grow. Don't sell. Don't trigger taxable events. Just let that money stack up on paper like you're playing Monopoly with real houses and real hotels. And when you need cash to live your life, to buy that mansion, that yacht, that private jet, you don't sell. You move to phase two. Phase two, borrow. And this, my friends, is where the magic happens. This is the move that separates the millionaires from the billionaires. This is the jujitsu move that flips the entire tax system on its head. Here's how it works. And pay real close attention, because this is the part they definitely don't teach you in school. You've got $100 million in stock. You need cash. A regular person would sell some stock, pay capital gains tax, currently 20% federal, plus 3.8% net investment income tax, plus state taxes, and walk away with maybe 75 cents on the dollar. But you're not regular. You go to your private banker, Goldman Sachs, JP Morgan, Morgan Stanley, whoever your people are, and you say, I'd like a securities-backed line of credit, please and thank you. And the banker says, why certainly, sir. We'd be delighted to lend you $50 million against your $100 million portfolio. The interest rate will be approximately 2 to 3%. 2 to 3%. While your portfolio is earning 8, 10, 12% a year, you're borrowing at 2 and earning at 10. That spread, that's free money. That's arbitrage. That's the game. And here's the beautiful, diabolical, absolutely genius part. Borrowed money is not income. Let me say that one more time for the people in the cheap seats. Borrowed money is not income. The IRS does not consider loan proceeds to be taxable income. Never has. Probably never will. Think about it. When you take out a mortgage, do you pay income tax on the loan amount? When you use a credit card, does the IRS send you a bill for the charges? Of course not, because it's debt. You got to pay it back. So they don't tax it. The ultra wealthy took that simple, common sense rule and turned it into the greatest tax avoidance strategy in the history of civilization. They borrow against their assets, spend the borrowed money however they please, mansions, jets, islands, political donations, and they never trigger a single taxable event, not one. And the interest they pay on the loan? In many cases, that's tax deductible too. So not only are they not paying taxes on the money they're spending, they're actually getting a tax break on the cost of borrowing it. It's like the government is paying them to be rich. I mean, you can't make this stuff up. Let me give you some real numbers so this really hits home. Scenario A, regular Joe. He's got $1 million in stock. He needs $500,000 to buy a house. He sells half his stock. He pays roughly $100,000 in federal and state capital gains taxes. He nets $400,000. His remaining stock is worth $500,000. Scenario B, wealthy Wanda. She's got $1 million in stock. She needs $500,000 to buy a house. She borrows $500,000 against her stock at 3% interest. She pays $15,000 a year in interest, which might be deductible. Her stock stays intact and keeps growing. Her total tax bill, zero. Fast forward 10 years, regular Joe's remaining $500,000 has grown to about $1.3 million, but he already lost $100,000 to taxes. And he's been paying income tax on his salary every year to make ends meet. Wealthy Wanda's full million has grown to about 2.6 million. She's paid maybe 150,000 total in interest over 10 years. But her portfolio has gained 1.6 million in value, untaxed. She's ahead by over $1 million. And she hasn't paid a nickel in income tax on any of it. That's the borrow phase. You live like a king on borrowed money, your assets keep growing tax-free, and the IRS can't touch you, because technically, on paper, you're in debt. The richest people in the world are, on paper, the most indebted people in the world. And that's not a bug in the system, that's a feature. Now, and I can see some of y'all thinking this, but the loan's gotta be repaid eventually, right? Somebody's gotta pay the piper. When does the bill come due? Great question. And the answer is gonna make you either real angry or real inspired, depending on how you look at it. Because that brings us to phase 3, the grand finale, the thing that ties this whole beautiful, maddening scheme together. Phase 3, die. Yep, you heard me right. The final phase of the greatest wealth strategy ever devised is dying, kicking the bucket, shuffling off this mortal coil, going to meet your maker with a portfolio full of untaxed gains and a belly full of borrowed caviar. Now I know that sounds morbid, but hear me out, because this is where the IRS code pulls off its greatest magic trick, a trick called the step up in basis. Here's how it works. When you die, and we're all gonna die, so don't get squeamish, your assets get passed on to your heirs, your kids, your grandkids, your trust beneficiaries, whoever. Now, normally, if you were alive and you sold those assets, you'd owe capital gains tax on the difference between what you paid, your cost basis, and what they're worth now. If you bought Amazon stock for $1 million and it's worth $100 million, you'd owe tax on $99 million of gains. But when you die, the IRS does something absolutely remarkable. They reset the cost basis to the current market value at the time of death. That's the step up. Your heirs don't inherit the stock at your original cost of $1 million. They inherit it at the current value of $100 million. So if your heirs turn around and sell that stock the very next day for $100 million, how much capital gains tax do they owe? 0. Because as far as the IRS is concerned, they bought it at $100 million and sold it at $100 million. No gain, no tax. $99 million in appreciation just vanished from the tax rolls like a ghost in the machine. And what do the heirs do with that money? Well, first things first, they pay off granddaddy's loans. Remember those securities-backed lines of credit from phase 2? The ones he used to live large for 30, 40 years without paying taxes? His heirs sell a small portion of the stepped up stock, tax-free, and pay off those loans. Boom. Debt cleared, no taxes paid, not by him when he was alive, not by his heirs after he died. Let me walk you through the whole cycle one more time so you can see the full picture. Step 1, buy assets. Let them appreciate, don't sell, no taxes. Step 2, borrow against those assets. Spend the loan proceeds. Live like royalty, no taxes. Step 3, die. Assets get stepped up. Heirs sell just enough to pay off the loans, no taxes. Step 4, heirs take the remaining assets, start the cycle all over again. Buy, borrow, die. Generation after generation after generation. This ain't tax evasion. Tax evasion is illegal. This is tax avoidance, and it's perfectly 100% legal, written right there in the tax code. Section 1014 of the Internal Revenue Code. Look it up. It's real. It's legal, and it's been the backbone of dynastic wealth in America for over a century. The Waltons, the Kochs, the Mars family, the Lauders, generation after generation, passing down billions without ever paying capital gains. The rich don't just stay rich, they get richer. And the mechanism that makes it possible is baked right into the law. Now, some of y'all might be wondering, how in the Sam Hill did this happen? Who wrote these rules, and why hasn't anybody changed them? Fair questions. The answer is as American as apple pie and corruption. The tax code didn't get to 70,000 pages by accident. Every single one of those pages was fought over, lobbied for, and paid for by somebody with deep pockets and a vested interest. The financial industry spends billions with a B, every year on lobbying. They got armies of lawyers and accountants whose sole job is to make sure these loopholes stay wide open. And here's the thing that'll really butter your biscuit. Every time Congress talks about closing these loopholes, about taxing unrealized gains, about eliminating the step up in basis, what happens? The lobbyists swarm Capitol Hill like locusts. Campaign donations flow like moonshine at a barn dance. And somehow, mysteriously, the reforms never quite make it through. They tried in 1976, repealed before it took effect. They talked about it in 2010, went nowhere. Biden proposed it in 2021, dead on arrival. Every single time, the same result. The loopholes stay. The wealthy keep winning, and regular folks keep paying. Now, I ain't here to get all political on you. I ain't here to tell you which party's to blame, because frankly, they both got their hands dirty on this one. I'm here to tell you the facts. And the fact is, the system is what it is. You can spend your whole life complaining about it, or you can learn the rules and start playing the game. So here's where we flip the script. Here's where we stop being victims and start being players. Because the truth is, you don't need $1 billion to start using these strategies. You just need to change how you think. Stop thinking like a laborer. Start thinking like a lender. A laborer trades time for money and pays taxes on every dime. A lender puts money to work, borrows against the growth, and lets the tax code work in their favor. Now, let me give you 3 concrete tools that regular folks like you and me, can start using to protect and grow their wealth. Tool number 1, the Spendthrift Trust. A spendthrift trust is a legal entity that holds assets on behalf of beneficiaries while protecting those assets from creditors, lawsuits, and, in many cases, certain taxes. When you put assets in a properly structured spendthrift trust, those assets are no longer yours in the legal sense. They belong to the trust. And what you don't own, creditors can't take. And in many cases, the taxman has a harder time touching. Tool number 2, the Nevada Asset Protection Trust. Nevada ain't just for gambling and quickie weddings, my friend. Nevada has some of the strongest asset protection laws in the country. A Nevada Asset Protection Trust, also called a Domestic Asset Protection Trust or DAPT, allows you to be both the creator and a beneficiary of a trust while still protecting the assets from creditors. And Nevada has no state income tax, no state capital gains tax. The statute of limitations on fraudulent transfers is just 2 years, one of the shortest in the nation. Tool number 3, the LLC with charging order protection. When you hold assets inside a properly structured LLC, creditors who win a judgment against you personally can't just seize the LLC's assets. The most they can get is a charging order, which is basically a lien on your distributions from the LLC. But here's the kicker. If the LLC doesn't make distributions, the creditor gets nothing. Meanwhile, the assets inside the LLC keep growing, protected from outside claims. Now, you stack these 3 tools together: assets inside an LLC, owned by a Nevada Asset Protection Trust, structured as a spendthrift trust for your beneficiaries, and you've built yourself a fortress. A legal, legitimate, ironclad fortress that protects your wealth, minimizes your taxes, and sets your family up for generations. Is it simple? No. Does it require professional help, a good attorney, a good CPA, a good financial planner? Absolutely. But is it worth it? Ask the Waltons, ask the Rockefellers, ask any dynasty family that's been passing down wealth for 100 years. They'll tell you, the cost of setting it up is a rounding error compared to what you save. Let me leave you with this, and I want you to really let it marinate. The American dream ain't dead. It ain't gone. It ain't been shipped overseas or buried in some politician's backyard. The American dream is alive and well. It's just been hidden. Hidden behind 70,000 pages of tax law that nobody told you to read. The tax code isn't a bill, it's a set of instructions. Instructions that the wealthy have been following for generations while the rest of us were too busy arguing about which political party was gonna save us. Nobody's coming to save you. No president, no congressman, no TikTok guru. The only person who's gonna change your financial future is you. And the first step? Educate yourself. Learn the rules of the game, because you can't win a game you don't know you're playing. Buy, borrow, die. 3 words, 3 phases. One strategy that has created and preserved more wealth in America than any other. And now you know about it. So the question is, what are you gonna do with this knowledge? Are you gonna close this video, shake your head, and go back to scrolling? Are you gonna keep complaining about how the system's unfair while doing absolutely nothing to change your situation? Or are you gonna get up, get educated, get a plan, and start building something that lasts, not just for you, but for your children, and their children, and their children after that? The system is what it is, folks. It ain't gonna change anytime soon, but you can change how you move within it. You can stop being the one who pays and start being the one who plays. America's next financial shift is coming. It always does. The question ain't whether it's coming, the question is whether you'll be ready. Whether you'll be standing on the right side of the equation. In the United States of America, the tax code ain't your enemy. It's your instruction manual. 70,000 pages of instructions written for those with the gumption to read them. The American dream ain't dead. It's just waiting for you to claim it. So go claim it. Buy, borrow, die. Now share this with somebody who needs to hear it, because knowledge ain't power unless you use it. And in this country, what you don't know will cost you everything.